Well, it's a warm welcome to you from a very cold Europe. My goodness, the Russian weather has come to the UK, and I'll show you. In fact, I'll show you in just a minute what it looks like over here. Thanks for joining us for the Biz News SA Champions Portfolio. I'm Alec Hogg, and I'm coming to you from London. If you have a look around there, I'm going to try and show you outside of my window, and you can see it looks like a winter wonderland. I don't know how much of that you can see, but I can tell you it was -5 degrees when we got back from London yesterday, and a very, a very, very cold place to be. I was talking to one of our colleagues who said it was rather cool in Johannesburg, and that the rather cool Johannesburg she was talking about was that it had gone to 21 degrees. Well, I can tell you what, to give that, to have that as an option in the UK at the moment would be a real pleasure. I'm going to be bringing up the portfolio for you in a moment, as these things tend to happen. I just want to make absolutely sure that we've got all the technicals 100% right. Stuart Lowman, my colleague, who's our managing editor of Biz News, is in Johannesburg. Stuart, do you want to just take us through how the webinar is going to work?
Excellent, thanks, Alec. Always good to be here. Just quickly, before we get started, there should be a little high five button that you can push if you can hear my voice and you can see Alec's presentation. You can just click that so that I know everyone's on board. I think that's coming through now. Yes, I got a few hands. That's excellent. Thanks very much. The other thing, so as we run through the portfolio, Alec likes to keep it very conversational. There's a little questions bar on the control panel on the right-hand side. If you plug your questions in as they come to mind, I'll pass them on to Alec, and we can sort of create a conversation around what's being said as he goes through the portfolio. But Alec, I think that's it from my side, so I think we can get cracking to what's going to be an exciting update, I think.
Well, it certainly is. If you recall, going into the elective conference, we had a mandate which said investing in South Africa's champion companies in the international sphere, driven by its best entrepreneurs. We've changed that mandate after the ANC elective conference to invest in South Africa's champion companies driven by its best entrepreneurs. In other words, no longer is it necessary for them to be global companies. We now want to take advantage of the opportunities that are available in South Africa. It's a big change for us at Biz News. For the last at least 5 years, certainly we launched our global portfolio at the end of 2014. And our view then was that you needed to protect yourself against Zumanomics by investing offshore. We've now changed that philosophy, and the view is that great opportunities exist in South Africa. I'll tell you a little bit more about that as we go along. But the mandate...
Alex, sorry, can I just jump in, Alec? I've got a few queries on the sound. It sounds okay, Mars. I don't know if you can just bump your sound up a bit. They seem to say you're a bit soft.
With absolute pleasure. I'll tell you what, if I keep talking now and give that a bit louder, how does that sound, Stu?
Yeah, it sounds a lot louder, Mars, but I'll just check if anyone else. Much better. Yes, I've got a few much better, so that's excellent. Thanks, Alec.
Perfect. Apologies about that, and thanks for letting us know. That's a wonderful part about a webinar, is that you can engage instantly. Okay, just to get back to the thrust of what I was mentioning a moment ago. Our mandate has changed. No longer do we only invest in companies which are international, that are protecting us against Zumanomics, because Zumanomics is over. It doesn't exist anymore. So we're now talking about investing in South Africa's champion companies driven by its best entrepreneurs. That's the mandate for the SA Champions portfolio. And really, it's the restructuring of the portfolio today, and we've made some big changes, is due to a restructuring of the exchange rate. As you can see from this graph that we brought through from our new partners at the Wall Street Journal, and by the way, if you are not a premium subscriber and you're coming along for the ride, and we're quite happy to have you here today, just to let you know that we have 2 of these webinars every month, one on the global portfolio, which is generating 32% compound annual growth rate since launch in December 2014. And the other one is this SA Champions portfolio, which hasn't done as well, but we'll tell you more reasons for that in a while. The partnership that we've struck as of today with the Wall Street Journal has given our subscribers, Biz News premium subscribers, get the whole back end of the Wall Street Journal as part of their subscription. We're not increasing the price. It's still £4.99. In fact, if you have a look at the Rand here, you'll see that since mid-November, the Rand has appreciated by 20% against the US dollar. and that means, and also against the pound. And that means that your BizNews Premium subscription is actually 20% cheaper. So that's all good news. There we go. There's the structural change in the rand against the pound. When you look at both of those, the rand was moving weaker against hard currencies until the elective conference, until and there's an absolute direct correlation here. As you can see, mid-December, when Cyril Ramaphosa was elected as the ANC's new president, the rand just started rushing against the British pound from over 18 to just over 16 at the moment. So a much better return for your rands in a global sense. From a broader perspective, the South African gross domestic product in US dollar terms, in other words, how the country rated against the country's economy rated against other economies around the world, it was sitting at $400 billion US dollars in 2011. And it had got as low as $300 billion US dollars just over the last year. So it's been declining in a straight line, thanks to very poor economic management in the country. With the appreciation of the rand, we're back at $400 billion US dollars. It just shows you how big and how relevant this change has been. 25% contraction in global terms of the economy over 6 years has been wiped out in a very brief period of time. But it still means that the economy in dollar terms has flatlined since 2011. And now our belief is that that is going to improve. This is the reason for it. Cyril Ramaphosa was elected very, very narrowly. It was a wafer-thin margin. There were 4,700 delegates. Of those, 90 voted for Ramaphosa and gave him that majority. Had those 90 gone in a different direction, had they gone with Mrs. Zuma, we would have had a perpetuation of the Zuma legacy, and that a 20% appreciation of the rand and the new hope that is being installed in the country would not exist. It's that simple. So it was on a knife edge. Our view, incidentally, has been consistently throughout, was that Ramaphosa would win. Our belief was that the ANC delegates would have a balance of those who realized that the country was going in the wrong direction and that they would vote in his favor rather than taking the country towards a Zimbabwe type outlook. However, it was a lot closer than we anticipated. And as you can see, certain deals were struck, as they always are in politics. And we now have a deputy president in David Mabuza, who many thought was most unlikely candidate. However, politics are sometimes the politics of compromise, and that's where we are. We're very excited about what's happened since Ramaphosa was elected as the ANC's new president. I saw firsthand in Davos the excitement that was generated amongst international investors. Indeed, even before arriving in Davos, after being a polecat for investors around the world, South Africa suddenly was nominated as the hottest market of all emerging markets by Goldman Sachs, the most influential firm on Wall Street. That report circulated ahead of Davos. When we got to Davos, we had pretty good access, in fact, to Mr. Ramaphosa, but most of his time was taken up by talking to foreign investors. He was swept off his feet, as were other members of the South African delegation. So there's been a seismic shift in the perception of South Africa internationally, and you saw that in the figures that this graph here with the rand. That kind of appreciation against the pound and against the US dollar is it takes a lot of money. It's a huge weight of money that would drive that. And we've seen no reason for the rand to reverse post Ramaphosa's appointment. He is the State of the Nation address. Well, the way he managed Zuma's exit was brilliant. It could really have been a lot more difficult. The State of the Nation address was excellent. The budget, you can have all kinds of question marks around it, as we do, but it is based on the view that the economy is going to rise. And if you look at this graph carefully again, and you see the way that the rand has improved, it's telling you that the perception of international investors that come into South Africa is just that much higher. So, consequence of that, we need to do something different with our portfolio. We didn't panic ahead of the elective conference. The idea was and I said this in the monthly webinars, these are the stocks we have in our portfolio. We structured the portfolio for an international exposure. We did bring First Rand into the portfolio recently, and as you can see, it's been one of the star performers on the basis that it was investing in Aldermore. It spent 20 billion Rand in a British challenger bank when we made that acquisition. That gave us the sense that they would be looking more and more internationally, and all the other stocks in the portfolio are international, have huge international operations. But if we're now saying that that's no longer the mandate that we have, that we no longer have to go just for South African companies that are being, or South African champions that are operating in the global market, it means that we can make some significant changes to the portfolio. And no surprise, and I always get the questions about Mediclinic, no surprises for those who've been following this portfolio for a long time that we've actually dropped that one out of the portfolio now. And here it is. Here are our sales. Now, we've rebalanced the portfolio, and you'll see the rebalancing in a little while. It required us to sell 2 Naspers shares. It wasn't that we've lost faith with Naspers. It still is our biggest holding with 25% of the portfolio, but it's down from 31%. We have sold out of Mediclinic entirely and taken that 26% loss. The MTN shareholding has also been sold entirely. Both MTN and Mediclinic are turnaround situations. So if you've got a few of them in your own portfolio and you're prepared to wait for 3 to 5 years, you're probably going to do okay out of both of them. But as far as this is concerned, the SA Champions portfolio is concerned, we tried to unlock some cash to reinvest in South African focused shares, given the change in the mandate. And as a consequence, both of those stocks are now out. First Rand, we really didn't want to sell, but we had to do so because its performance has been so good that it's now substantially above the 8% that we've allocated to it. And as a consequence, we took some profit on some of the First Rand shares. Similarly with Discovery, which has been a great performer, we have it in as 20% of our portfolio into the future because of the price rise that had gone way above that. And we made a nice profit of over, I haven't put it in now, see, but over 50%. That brings us to, we raised cash from the portfolio from a 100,000 starting point to 33, just under 34,000 Rand. And that has been allocated in this way. We've bought in to the Ashburton Mid-Cap ETF. I'll explain that in more detail as we go through this presentation. But in essence, it invests in companies outside of the JSE Top 40, and most of those companies are invested in South Africa Inc. So they're exposed to what goes on within the country. That's the exposure we want. Wilson Bailey, although it has a fantastic business in Australia, and it's recently acquired a business in the UK, which is a very sensible way that it's gone about it. Burn is a small investment in financial terms, but a big investment in opportunity. But Wilson Bailey is clearly the market leader in South Africa in the construction sector. We've brought it back into the portfolio. Long-time followers of the SA Champions will remember that the Wilson Bailey was in the portfolio at one point in time. And then we brought in Long for Life. Now, if you'd been with us last month, you will know that for those who are putting in monthly amounts through the Easy Equities bundle, we said instead of putting it into Steinhoff, which we sold out of entirely after the disaster in December, we said that that money would now go into Long for Life. You got in at around 5 Rand. Our portfolio is getting in at 567. So those who followed the Long for Life suggestion are actually doing okay at the moment, more than 10% up. But as you can see, total purchases came to 32,500, which leaves us with 1,200 cash, which is, according to Easy Equities, we need to have 1% in cash. And there's what the new portfolio looks like. 3 new additions and 4 long-term holdings. So Naspers, Discovery, and First Rand have been our big winners here. Investec has started shooting up recently. Very happy with the 15% there. And then the newcomers, Ashburton Mid-Cap ETF, that's an exchange-traded fund, plus Long for Life and Wilson Bailey. Those are that's the look of the new portfolio. Stu, I see there are a few questions. Do you want to take some now?
Yeah, thanks, Alec. Just from Philip, he asks on the Rand hedge. He says, is the land expropriation without compensation process an associated change to the Constitution not an indication that we should stick to rand hedging in the long term?
Yeah, it's a very good question, and it is it's sticking out like a sore thumb. My sense of that issue is that there are historical things that happened in South Africa which we cannot just wish away, that need to be addressed. If you take people off the land for political reasons, and we had the 1913 Lands Act, and we had quite a lot of land expropriation without compensation after 1948, you've got to fix it. And you can't just let that festering sore continue. And that's the reality of what Ramaphosa is saying. However, there is an example to the north of how not to fix it. And what has happened in Zimbabwe is a very, very good lesson for South Africans. And with a Ramaphosa driving this rather than, say, a Malema, you will have a far more measured and fair approach towards this issue. It's a problem issue for South Africa. It's one of those really raw nerves, but it is something that is likely to be handled from everything I've seen in a responsible and mature manner. Everything about Ramaphosa is responsible and mature. He's not going to go and become a populist and start throwing the baby out with the bathwater to rectify something that needs to be rectified. So no, I'm not concerned about how that whole process will unravel. I'm actually very happy that something is being done about it, because the longer you leave a potential festering sore, and this is something in South Africa, the whole rise of the EFF and some of their insane economic policies that they'd like to introduce is directly a result of not dealing with the land issue, or dealing poorly with the land issue in the past. Once we see that this responsible administration applies its mind and does things in the right way, I think that it's actually going to be a positive for the country rather than a negative.
Excellent. Thanks, Alec. There's a comment, or someone looking for comment on Sibanye-Stillwater. I know it's been big in the news with all the acquisitions and stuff. I don't know if you want to keep that for after the company discussions, but just some comment.
I did look at it. I did look at Sibanye-Stillwater. In fact, I'm a big fan of Neil Froneman's, and the Stillwater deal is a good one. My concern about that is the longer term prospects for palladium and platinum. With the shift towards electric cars, palladium and platinum have got a lot of wind in their face. Unless they can find fuel cells or another alternative, and they are fantastic minerals, which surely would be able to be applied in other ways. Right now, remember that the majority of the offtake for both of those metals, and that's where Sibanye is invested, is in catalytic converters. And catalytic converters are not needed in electric vehicles. So you are investing in something which is probably not going to be required, well, certainly is not going to be required in 20, 30 years' time. But of course, there is going to be there's always an option, an alternative that it can go somewhere else. Neil is a very good miner. He's done a good deal with the palladium business in the United States. He's diversified the portfolio amazingly well, but he still is in platinum and palladium as his major output now. And from that perspective, apart from anything else, or apart from the overriding view, which is that you should be investing in people, not in inanimate objects, that inanimate objects can only give you a return of what the market is or the way the commodity prices are going, whereas individuals can unleash huge potential. I've never really been a great fan of mining stocks. There are times when they're cheap and people have made a lot of money out of them, but by the same token, people have also lost a lot of money out of them. So sorry, no Sibanye in this portfolio for now.
Thanks, Alec. I think the questions have been dealt with for now. Thank you.
Right, let's move on to the individual portfolio. But anyway, just before we do that, just to dwell here for a minute, Naspers is about 25% of the South African index. Depends on which one you're looking at. So at the very least, we will have that in our portfolio. I'll tell you a little bit more about that in a moment. But if you have less than 25% of Naspers in any portfolio, then you are taking a negative bet on Naspers. And I certainly wouldn't be doing that. Discovery has been our star performer, as you can see there. So we have a 20% share. Because it's done so well, the stake that it held in the portfolio went up to almost 25% itself. And we've now reduced that in this restructuring to 20%. Investec Limited, we're still sticking with 15% there, and there's a very good story unraveling. Ashburton Midcap ETF, also at 50%. So between those four stocks, you are sitting at, 75%, 3/4 of the portfolio. And then we have three stock picks with First Rand, Wilson Bailey Homes, and Long for Life, which are 8% each, and then 1% cash. And that's the way that this portfolio has been balanced. I'll take you through the individuals now. Naspers, that's Bob van Dijk, the chief executive of Naspers. It is a play on Tencent. If you look at this graph carefully, you'll see that the black graph is the Naspers share price, which has performed incredibly well. And this is over the last year. The blue graph is the Tencent share price. And incidentally, this is taken from the Wall Street Journal. As a premium subscriber, you can get into all of these graphs and manipulate them and fiddle with them as you want to. South African stocks, international stocks, anything in the world. It's a fantastic facility, and this alone is probably worth investing in our premium subscription. But as you can see there, Naspers has underperformed Tencent over the last year substantially. This is why in December, Bob van Dijk took his team over to New York to have a conference. Since December, the rand has appreciated, so that has kept the Naspers share price down again. So the Hong Kong dollar easing against the South African rand, so hence the widening in the gap. I haven't done the latest calculation on the two, but last time I looked, there was a 40% discount between Naspers' valuation or value and what its underlying portfolio was. So you could buy into Tencent effectively at a 40% discount by buying Naspers shares. This is something that's been picked up by a lot of international investors, and they're starting to look at it. But of course, if they'd bought Naspers shares recently, they wouldn't be terribly happy. And the reason for that is that the rand price of Naspers shares has, of course, fallen given the enormous strength that you've seen in the South African rand. As a longer-term bet, Tencent is a phenomenal business. It's worth $550 billion US, worth more now than Facebook. Excuse me. And the future of this company looks stronger and stronger. If you're in China and you have a cell phone, you don't use an Apple system or a Huawei system or a Samsung system. You use Tencent. Your operating system is WeChat, which is used by 900 million people in China. Extraordinary numbers that we can't even get our heads around as South Africans, given that we're in a country which has got less than 60 million people. So as a longer term bet, Tencent is now moving into other parts of the world. Naspers has always resisted the demands from investors that it offloads or unbundles its Tencent shares. This is a demand that has been going on for, well over a decade now, because they only bought into Tencent in 2000. Naspers initially bought 50% of Tencent. It now, through the listing, etc., is down to about a third. So it's around about 34% that it owns. But that is 34% of one of the biggest companies in the world. As a South African shareholder, you've got a wonderful option on this massively growing company. And the difference between tech companies in America and tech companies in China is that in China they have the support of the government, whereas in America, under Trump at least, they have their antagonistic flow from the government. So, as far as we're concerned, Naspers is a cornerstone for any South African portfolio. And also, Tencent is a stock that if you have money offshore, it's probably not a bad idea to buy indirect. Onto the second big holding in our portfolio, and the one that's done incredibly well. Well, in the past month, as you can see, Discovery has recovered. It also, a lot of the international related stocks took a hiding in early February, as did Discovery. But if you look at what went on in stock markets around the world, after that sell-off, there has been a rebound, and as it's happened with Discovery as well. Discovery is a South African company. The head office, which I walked around while in Johannesburg last week, is the biggest office building occupied by a single tenant in the Southern Hemisphere. Isn't that interesting? It's very, very smart, and gives you an understanding of how Discovery is preparing itself for a future where sustainability and engagement of its staff is a very high priority. The Discovery story is a compelling one. It works on a shared value concept, where what Discovery does is it provides, it's targeted the major areas that kill us, and that's diabetes. Well, essentially what happens, we as human beings, we get sick or we die because of four things, really: smoking, drinking. I guess you could say both of those to excess, but anyway, those two, poor diet and no exercise, and they translate then again to the four diseases that kill people and make us sick. 80% of your health costs are related to those four issues. So what Discovery does is it incentivizes its clients to smoke less or not, to drink less or not, to exercise more, and to eat better. And by doing those four things, or incentivizing them, the clients benefit, but so does Discovery benefit, because its claims ratios fall. That's really the essence of this business. And it is rolling out this idea around the world. Ping An, which is the Chinese operation, the Chinese partner of Discovery, has already got nearly 4 million people who've signed up, and they've only been going just over a year. The UK operation, Vitality, is going like a steam train, made £40 million profit last year. So that's in a different stage of development. And of course, in South Africa, Discovery has a dominant position, because it's very hard, once you have the scale that Discovery has and the incentives and the groups around it, it's very hard for competitors to get a foothold in that market. Discovery is a fantastic company with an amazing business model and very smart people. So extremely happy to have 20% of the portfolio in that one. So those two were long-standing. We'll get onto the new ones now. Sorry, Stu.
Sorry, Alec. Just on Discovery, comment from Ed: why the move to banking? And then from Bio, it just says actually a long comment from Bio. It's a comment on Discovery. My view on Discovery is that it is one of the most successful SA and perhaps world data mining businesses. The fact that it has an excellent product called Vitality and medical schemes and insurance. So I think that's just a comment from Bio. But Ed wants to know why banking for Discovery.
Now, maybe to start with the second one first. And the engagements that I've had with them, they have been into big data for years already. They're very excited about the potential that artificial intelligence can bring to making better products and to understanding their clients better, and being able to, as a result, help their clients to be healthier and to make more money out of it for both parties. As far as the banking is concerned, the Discovery guys had told me that this is a ring-fenced operation. We do know that the former head of SARS Tech at SARS and at Nedbank Tech, Barry Hoare, is the driving force behind the bank. Barry Hoare is extremely highly rated in everything that he's done. If you look at SARS e-filing, that's his baby. And certainly when Nedbank was ahead of the game on technology, Barry was the guy driving it. So it's got a great pedigree. But it's quite an obvious market for Discovery to go into, given that it's got a credit card with 250,000 people. And it's got millions of people who already sign up through its health insurance plans. Plus, it has data on lots of them. So for Discovery to not go into banking would have been a surprise, rather than the fact that it is going in there. It's quite a contested space at the moment in banking, certainly retail banking. I don't know if those of you who read Felicity's comment this morning in accompanying the premium newsletter will see that Goldman Sachs from the US, who are the bluest of blue blood investment banks on Wall Street, is also going into retail banking as well, because that's where the margins are. So to see Discovery making a move in that direction with someone like Barry Hoare driving it doesn't surprise me at all. It shouldn't. It's just a logical extension of their business model.
Thanks, Alec. Pierre just wanted to finish his comment. Sorry, he didn't finish it earlier. He said, the Vitality and other products are excellent byproducts of their data mining. Adrian is an actuary. Actuaries love data and stats. His observations. Sorry, just to finish that comment.
And so does Hilton Kellner, who's the head now. I think Hilton's just taken over the life business, one of the businesses there. He has also also an actuary, and he also loves data too. So it's a kind of company where people are. I remember a very smart venture capitalist once telling me that he likes to invest in businesses where he gets highly intelligent people, puts them into a room and just pumps in oxygen. He said the magic happens. And that's what investing really should be about, is investing in human potential and investing in this amazing thing that we've got called the brain, and let the magic happen. That's exactly what is going on with Discovery. 20% of the portfolio there. Some people might say it's a bit much. In fact, 45% in just 2 stocks. I defer to Warren Buffett in this regard. He's got 67% of his portfolio in just 5 stocks. So he's got 2/3 of his entire portfolio in 5 stocks. And his view on this is that you should invest in companies you know well, follow them well, understand them well, and then you'll know when something is going wrong, or indeed if it's worth adding more to that to your holding there. And he's got in his portfolio of his top 5, 3 of them he's held for something like 20 years. That's Coca-Cola, Wells Fargo, and American Express. Those 3 companies he's held. American Express he's held since the 60s, and the other 2 he's held for at least 20 years. So those are the Buffett philosophies, and we're trying to do a similar thing here as well, wherever possible, to follow what Buffett believes in. There's Stephen Kossoff. He's going to be leaving Investec and in the next year, but the succession planning by Kossoff and the man who runs the UK operation, Bernard Cantor, has been exceptional. If you have a look at the share price, once the Steinhoff story hit in early December, the shares dropped from 95 to 85 Rand. At that time, there was concerns, given that Bernard Cantor and Steinhoff's principal, Marcus Jooste, were close friends and had racehorses together and certain other business interests. The concern was that Investec would have got sucked into the whole Steinhoff pot. Well, it came out pretty quickly within days of the Steinhoff debacle to articulate exactly what the exposure was, and it was limited. Most of this exposure to Steinhoff, apart from the shares that are owned by South Africans, was actually to international banks. And rarely is there an international bank coming out with results lately that hasn't had to report some kind of a hit from Steinhoff. But if you go along the graph here, and you'll see how it shot up in February, that was a result of the announcement of a change in the leadership. In other words, succession planning. Stephen Kossoff and Bernard Cantor have been running the organization. They were co-founders of it. It was founded in the late 1970s. And there's a huge benefit to having people like them at the helm for that long. But investors also like to see change. They like to see enthusiasm and new energy. And in the appointment of Fani Titi, who's going to do pretty much Stephen Kossoff's job in South Africa, and Hendrik de Tooy, who's going to do pretty much Bernard Cantor's job in London, you have got 2 extremely able new chief executives. The other thing that hasn't been factored into the share price yet, well, you can see how the share price has moved really well in the last month, but the other thing that hasn't been factored into this yet is that Investec owns a very big and a very strong asset management division. That's the division that Hendrik de Tooy started, literally, from himself and a PA from scratch. And he's built it up into this enormous giant, biggest by far of any South African asset management business because of its London operation. And I mention this because it seems to be a trend now where companies are considering spinning off their asset management operations. Deutsche Bank are doing it, and they are expecting to raise 2 billion euros from their spin-off. Investec's asset management company is a very important part of the bank, but on the other hand, it's also very undervalued. So as one sees the valuations of the asset management sides of businesses like Investec getting closer to, or getting more attention from the investment analysts, I'm expecting that will then have a further impact on this share price. So you've got two really big, good bull factors on this one. The new chief executives who will be coming, and they've been there for many, many years. Fani was the chairman of Investec, has been the chairman for quite some time. He's now going to take on an executive role, and in the political realities of South Africa, it certainly isn't going to hurt to have somebody from his background running the business there. And then you've got Hendrik de Tooy, who's been based in London for a long time now, so he understands how the UK operation works, and that is a very, very important part now of the Investec business. You've got those 2 points. So the succession is good. Also, neither Kosif nor Cantor are running away. They're not leaving in a hurry. They're both going to be there for quite some time. So that's you can be sure there'll be an efficient handover. But there's also this asset management game, this asset management play that hasn't quite been brought to the fore. The final point about Investec is that it is a bank, and banks are beneficiaries of economic upswings. The South African interests of Investec have been downrated over the years because of concerns about the economy. That is also likely to be a plus factor now into the future under a Cyril Ramaphosa regime. Here's the first of our newbies. We put 15% into the Ashburton Midcap ETF. Why? Well, this is an investment into the stocks on the JSE from position 41 to 100. So the people at Ashburton are not picking anything. What they've done is they've gone from the 41st biggest or most valuable stock on the JSE onwards. And the reason we wanted this is because from 0 to 40, most of those companies, or the biggest part of those ETFs, are focused internationally. These companies, you can read them, Goldfields and Exxaro, 2 mining stocks, not so much. But then you've got Clicks, Imperial, Foschini, Spar, Truworths, AVI, Life Healthcare, and so on. These are companies that are totally exposed. Netcare, not so much. But Barlow World, there's Sibanye. So we've got a tiny little percentage of Sibanye. Hyprop, Pick and Pay, Impala, MMI, and so on. Most of these companies will benefit hugely from an uplift in the South African economy. And don't forget that the South African economy has been under huge pressure since 2011. If you just to repeat again, in US dollar terms, the economy today, after a 20% depreciation in the rand, is only of the same size, $400 billion, as it was in 2011. So we've lost all that time. Now, if you're a business a significant size business, trying to make a living in a market or in an economy that is flatlining, it is very, very difficult. However, once that economy starts rising, you get a leverage or a gearing type effect. So I'm quite excited about this bet, and I must thank my friend from Standard Bank, Brett Duncan, who was the one who suggested that we look at it in the first place. Moving on to the share price of these, or the price of these exchange traded funds, as you can see, hasn't done a whole lot, unusually so, in the recent times. It's kind of bounced around from where it went to after the elective conference. So while you have some big increases in share prices that international investors have been taking their eyes out of on the South Africa rebound story, position 41 to 100 hasn't yet felt that impact, but it will, because that's the way it works. Usually the first thing is that investors buy the country, then they buy the big stocks, and then they buy the medium-sized stocks. So the medium stocks haven't moved yet, and that's the big opportunity that one is seeing here on the on Ashburton's side. There's again, just to have a look at them again, as you can see, these companies that are here, and I've only put the top 20. There's still another 60 odd companies with with much smaller percentages, but the top 20 by percentage, and you can see a very, very strong dominance there of South African focused businesses.
Alec, just a question on the mid-cap ETF. How often does it reweight, the stocks it holds? Do you know?
I don't know offhand. They traditionally reassess when the mid-cap index would reassess, and the JSE would look at that periodically, at least quarterly. They would look at it. So not within the quarter, but they'd get to the end of the quarter and then have a look at how the weightings have changed and then reweight it. And once they reweight it, then the ETF management company reweights as well. So Ashburton hasn't got a group of analysts there who are watching the share prices day by day and changing and trading. They will wait for the index itself to be adjusted. And once the index is adjusted, and it's always very well telegraphed, they will then do the adjustment themselves.
Thanks, Alec.
Moving on to another of our newbies. This is WBHO, and that's Mike Wiley, a fine entrepreneur. He's been with the company for decades. He is the chairman of the company, but still very involved in the business. He was previously the chief executive. And WBHO is a incredible story if you have a look at what's happened in the construction industry. Over the last 20 years, it's come from being a relatively small player to comfortably the dominant player. Its turnover of staff has been far lower than elsewhere in the industry, and its ability to win the contracts that it needed has been enhanced by the scale. It also has a huge business now in Australia and a fledgling business in the UK. We used to have Wilson Bailey in our portfolio, but the reason we took it out was because the South African business was just too important to the company, and we were trying to look at the time for international exposure. Now, its South African business is a critically important part of this portfolio's construct, and even though the share price has gone up, it's quite interesting. When I did my roadshow in South Africa in mid-February, it was sitting at 160, and it was one of the companies that I recommended would be worth buying if you were going into South Africa Inc. And as you can see, it worked against us in this portfolio because it's now sitting at 172. Nevertheless, this is still, if you consider the gearing effect that a company like Wilson Bailey in construction would have to a rebounding economy in South Africa, then it's still got a long way to go. Interestingly enough, again, looking carefully at that graph, if you go after the elective conference, this is one of the big winners. It came from around 140 to nearly 160 Rand in days. Then the enthusiasm tapered off, but since then, analysts have been doing their analysis and been readjusting and re-rating the company. I think the re-rating has still got a long way to go, given that the new administration of Cyril Ramaphosa, as it expands, as the economy expands, they're going to need to build things. And all you have to do is just drive around South Africa, look at the projects that are being built, and many of the most prestigious ones there are Wilson Bailey. In Australia, they have a similar situation as well, where they're building a huge constructs in Melbourne, Sydney, and in Perth. Go and have a look at the website, and I'm sure you'll be just as enthused about this business as I am. And there's the new chief executive of FirstRand. Alan Pullinger was announced this week that he will be taking over from Johan Berger, who retires soon. Pullinger comes from the RMB. He's a dyed-in-the-wool. He's been deputy chief executive of the company for quite some time. He knows the business a lot. FirstRand recently announced that it's acquiring Aldermore, a challenger bank in the UK. I'm excited about that because, having seen the way that UK high street banks operate, the opportunity for a challenger or for a retail bank in that space is significant. And we know that FirstRand it's the gold standard of banks in South Africa. Why FirstRand? Why is it worth buying FirstRand? Well, I think this graph will tell you everything. After the elective conference, the share price has gone from the mid-50s, and it just hasn't stopped. It's continuing to go in the right direction. The reason for that is that banks need a strong economy. And if you have a strong economy and you're a good bank and you're a well-managed organization, you will benefit from that, from the economic growth. It's almost the concept of a rising tide lifts all ships. It lifts most banks anyway, unless you have specific, smaller banks have specific concerns or issues. Banking stocks generally tend to benefit from a rising economy. First Rand is outside of Capitec, which is just a focused, retail bank. Of the big banks, First Rand has always been the highest, not always, but it's been the highest rated for some while now. And it's a very well managed operation in global terms, and one that is likely to make fewer slip-ups, perhaps, that will shock the system than its competitors. It is the gold standard. I really look very hard at Standard Bank, and was a bit well, Standard Bank is a fantastic business, and it also is extremely well rated relative to First Rand. First Rand is almost priced for perfection now. It can't really make too many mistakes and retain this rating, whereas Standard Bank, which is trading at a far less demanding rating, has got potentially more upside. But in cases like this, we've learned our lesson from turnarounds. The turnaround potential of Mediclinic still exists, as does MTN, but who knows how long it's going to be there for. Whereas if you are now having a company that is geared to the South African economy, which we do believe is going to lift off, then you have to be invested in that stock. And then finally in the portfolio, we have Brian Joffe, again, a great entrepreneur, the man who began Bidvest from scratch, much like the way Hendrik du Toit at Investec Asset Management started his company. Joffe was pretty much on his own. He left Wheeler Nashheim and decided with Investec, interestingly, with their support, to start Bidvest. And wherever you go in South Africa and in many parts of the UK now and other parts of the world, you'll see the fruits of those labors, with Bidvest's brands being pretty well identified all over there. He left recently to start Long for Life. The Long for Life, as you can see, had a good start to its listed career, getting to just below 700, as there was a lot of excitement about what Joffe would do. That excitement dissipated, as tends to happen when people get over enthusiastic. Joffe himself put his money in, 100 million rand of his own money in, at 4 rand a share. His supporters, his backers, all went in at 5 rand a share. At a time they were looking a little sad, because rest of us could have bought it cheaper than those close to Joffe would have bought at. However, it's moved up. In the beginning of in fact in December, we said that in this webinar that the money that would have been allocated to Steinhoff would in future go into Long to Life, and now we've formally included it in the portfolio with this restructuring. So if you buy whatever you put into Easy Equities into the BizNews SA Champions portfolio now, 8% of that will go into Long for Life automatically as part of your purchase. And there's the portfolio overall as it stands. As you can see, we are now with 3 newbies. Ashburton Midcap ETF with 15%, Wilson Bailey with 8%, and Long for Life with 8%. So that's 31% of the portfolio. The readjustment has been to take account of the changes, the watershed that happened at the ANC elective conference, and nothing subsequent to that has made us feel anything less than terribly excited about South Africa's opportunities. Of course, there are challenges. Of course, there's quite a mountain to climb for Cyril Ramaphosa and his team. But seeing the reinstatement of Nhlanhla Nene as finance minister, a very brave, a very conservative and responsible finance minister who was fired because the previous president was trying to ram through a nuclear deal and ill-advised loans to some of the state enterprises, and the return of Pravin Gordhan to the cabinet to run the most difficult portfolio of them all, the state enterprises portfolio, where his job will be to get them back on track, not only through attacking those who had corrupted those organizations, but by giving them the kind of role that this government wants in its developmental state, or the development state approach. Whether you agree with that or not is kind of irrelevant for the moment, because we are so far behind the black ball that we now need to at least get out of that snookered state in the South African economy to start growing again. And what Ramaphosa has done with his reshuffle, remember, it's not an entirely new cabinet, because that wasn't the former president resigned. It wasn't a whole new change, but he's managed to keep everybody comfortable. His State of the Nation address was inspiring. Certainly what we heard in Davos was incredibly encouraging when you see the rest of the world's attitude towards Ramaphosa, or a Ramaphosa-led South Africa. So the country needs economic growth to be kick-started again. It has the benefit of very strong companies which are sitting on a R1 trillion in cash that they can unlock. Once they start unlocking those and investing more into the future, then the international community will follow suit. There are three things that Ramaphosa is focusing on. He told us in Davos, and he hasn't deviated from this plan. That is certainty of the legislation in the first instance. That is attacking corruption in the second, and fixing state-owned enterprises in the third. He's put his trump card, if you like, Pravin Gordhan, to do the state-owned enterprises. He's now put Becky Cele as the head of police, and very soon we're likely to see a new head of the National Prosecuting Authority to go after the corrupt. And an example of greater certainty in the legislation is shown by his appointment of Gwedi Mantashe into the very controversial previously mining portfolio. The miners are delighted. They know Mantashe. He comes from that area, was formerly with the National Union of Mine Workers. He knows how mines work, and he will be able to provide a greater sense to the legislation that has actually stopped investment into South Africa. When I spoke with Roger Baxter from the Chamber of Mines about this, he said that a poll amongst his members showed that they were prepared to inject 80% more into capital expenditure if they have the right person running the mining portfolio. The appointment of Mantashe, the way it's been welcomed by the mining industry, will say that that door has now been opened. And then the other appointment, significant appointment, was in the energy sector, where Jeff Radebe, who's a veteran politician and a man who understands the business world as well, he has been given that responsibility. And you might have forgotten that it wasn't long ago that Royal Dutch Shell was prepared to spend hundreds of millions of rands prospecting for shale gas in the Karoo, but it turned off the taps entirely because of legislation that was wonky. Similarly, Total was spending lots of money drilling for oil off the east coast of South Africa, and also switched off the spending there. Now, with more certainty in the energy sector, for starters, you could see that coming to the fore. South Africa has, depending on who you believe or which research you believe, between the 4th and the 8th largest shale gas reserves in the world. And the shale gas has transformed the American industrial complex. It can do the same for South Africa and a whole lot more. The potential of this country has always been there. It just needed the right management to unlock it. And in Cyril Ramaphosa, a man who was instrumental in and very involved in the National Development Plan, you have the right person. I'm very confident about the way that the economy can go into the future, and hence the changes to our portfolio.
Thanks, Alec. Just a question on a company not in the portfolio. Neil Boyce wants to know your thoughts on Capitec. Obviously, one very much in the news with regards to Viceroy, etc.
Neil, Capitec have managed the communications of the Viceroy attack extremely well. It is a good company. It's well managed. The people, I've met them. They have integrity. They they have the technology that gives them management information systems that enables them to produce their annual results within a month of the year end. If there's any surprises in Capitec, they would know all about it. And on this one, whereas Viceroy were absolutely right when it comes to Steinhoff. The stuff that's coming out of Steinhoff is staggeringly concerning. But as far as Capitec's concerned, they have really engaged well. Remember, they were rated the best bank in the world by Michael Lafferty not long ago, in fact, for 2017. And Michael is the former banking and accounting correspondent of the Financial Times of London. So he's done his work on that one. He runs an operation that just looks at retail banks around the world. Capitec is an organization that has, however, perhaps from a stock perspective, from a valuation perspective, overrun itself. And I've consistently said this, at 6 or 7 or 8 even times price to book, you are really, really pricing this not for perfection, but for utopia, when you've got First Rand at 3.5 times price to book. And that's my concern. Can Capitec grow at double the rate of First Rand indefinitely? I doubt it. It's got to the stage where even now the 20% plus growth rates are now coming down to below 20% in Capitec's case. And that would be my concern with them. Not that there's anything crooked that's going on there. The Reserve Bank has also come out to say that it supports what Capitec's done. And it's not the first time there's been an attack on Capitec. You might remember the ratings agencies at some point. One of the ratings agencies had a full go at Capitec, and the Reserve Bank too came out at that stage. But are the shares cheap or offering huge value? No, I wouldn't see that. I would see the stock as being extremely fully priced. If you own them and bought them a long time ago, there's no reason to get concerned now. But if you're thinking of buying the stock at this level, surely there are better opportunities in the banking sector elsewhere.
Excellent. Thanks, Alec. Just before we go, Paresh wants to know your thoughts on the education sector with the likes of Curro, Advotech, etc.
Paresh, that's just got to be one of the huge opportunities into the future. I was talking to Anne Bernstein, who is with CDE, a organization that, a think tank, if you like, in South Africa that influences thinking and does a lot of research and then shares that with the business sector. And she was telling me that private schooling is booming in areas that we wouldn't have thought of. For instance, in the old townships, where many private schools are being created, where there's a need, where government is not providing, and education is a obvious area with the stranglehold that SADTU has on it, with the way that some of the jobs within education are actually bought and sold within the union. It's a mess that Cyril's going to take a while to get his hands around to fix. But while that is continuing, the private sector or parents of children are going to be looking for alternatives. And the boom of private education in areas that you wouldn't have anticipated that would exist tells you that in the more formal sector, where an Advotech and a Curro play, the opportunities are as big as ever. And certainly, if you have them in your portfolio, there's no reason to reconsider. I know that Curro has made some pretty aggressive announcements post the ANC elective conference. It's reaffirmed its confidence in South Africa, and rightly so, I believe.
Excellent, Alec. I think that's time up on our side, but thanks for answering those questions.
It is indeed. We like to keep these presentations to exactly an hour, and I see we've got 14 seconds left. So it's been a real privilege to be with you today. Those of you who are not premium subscribers, you can join us next month. If you sign up, you've got a 30-day free trial that you can go for. Those of you who are premium subscribers, look forward to being in your company again. We will next month be reverting back to mid-month for the SA Champions and end of the month for the global portfolio. So we'll get back to normal again. It's just we've changed these a little given my trip to South Africa over the last 3 weeks, but a very, very valuable exercise that was indeed. And when we look back in time, I'm sure historians are going to say that was a 3-week period that will go down in history as the time that the country changed for the better. Thanks for being with us. Look forward to being in your company again. And from me, cheerio.